conventional mutual funds are less flexible from an investment perspective. So there is a move towards what is called an exchange traded fund, what is called an ETF.
If you weren't in AI and finance, what field do you think you will be in?
My passion has been history, and music. So
Okay. In terms of the sentiment signals, how do they drive investment strategies?
Studies by academic researchers and Wall Street equity research firms confirmed that sentiment was a lead indicator of price change.
Specifically, when it comes to investing in finance, trust becomes really important. However, with StockSnips, it's kind of trusting an algorithm. How do you sort of deal with that?
That's a good question. Use of quantitative methods is not new. You go back 30, 40 years, they were using mathematical models, statistical models. AI is nothing but an extension of these quantitative models. What we're doing at StockSnips, we are beginning to look at how you can select stocks and in an optimal way. And there the goal, of course, is for a given risk, optimize return. So it's risk-adjusted returns. You can get a return, but the risk could be very high. I think where we are today, it's a combination of using AI as a tool to extend your cognitive capabilities. But when it comes to the intuition and actual decision-making, the human is still involved.
Imagine a world where you get real-time insights into how market sentiments are driving the stock performance. A world where AI can analyze thousands of new financial sources and give investors a competitive edge. Where investment decisions are data-driven and you can leverage AI to cut out all the noise and make smarter and more informed decisions. Welcome to Build with Shreya, where stories inspire you to grow and build something extraordinary. And today we are going to analyze a very interesting intersection between AI, finance, and investment strategies. And we had the perfect guest to break it down for us. So, welcome Ravi Koka, who is a visionary leader, serial entrepreneur, and who has transformed the financial technology over decades of experience. He's the founder and chairman of StockSnips, an AI powered sentiment analysis platform in the stock market. And before, he has built multiple ventures like SEEC as well as Intellect SEEC, reshaping the enterprise software as well as AI in financial services. So today, we're going to explore AI-driven sentiment analysis, reshaping the investment strategies, future of fintech and wealth management, as well as check out all the different challenges and opportunities that lie in scaling AI in financial services. So without further ado, let's welcome Ravi Koka to Build with Shreya. There is being this rapid transformation across different industries, specifically with AI coming into picture. So there are being these solutions which are AI driven, data driven, right? And specifically when we talk about financial technology and financial services, the transformation has been great. And you've seen that across your career. So right from developing financial technology solutions to AI driven financial tech solution like StockSnips, if you could tell us what took you on that path and what inspired you to be on this journey.
Thank you, Shreya, for having me on this program. I'm a computer scientist, and I was fortunate that I worked with one of the leading AI researchers. He was my mentor, and he was the one who built the first speech recognition system at Carnegie Mellon University. And that's really what inspired me to look at natural language processing and AI. And in my previous company, it so happened that it was an enterprise software company, and most of my customers were either banks or insurance companies. So I got exposed to financial services. So after I exited from my previous company, and when I was looking to see what's the next thing to do, I felt that given the rapid changes in AI that was happening and my domain knowledge of finance, that intersection is what got me to, starting this new venture, StockSnips.
I want to know a little bit about the Kansas State University. You were in the inaugural batch of computer science in the university, and it's a very research-oriented and academically inclined institution. So how was that experience, specifically because, that time computing was just sort of becoming the rage, and that time was very different. So if you could tell us about that experience.
So when I did engineering in Madras, at that time it was called University of Madras, I got exposed to programming. In those days it was an old IBM 1401 computer with, and we used to write, Fortran programs on that. And I somehow liked this whole software development. And so when I applied to Kansas State. And in Kansas State, I mean, the reason I chose that was it was a land grant university, so the fee was going from India, the fee was much more reasonable. But then once I went there, I found out that their computing facilities were pretty state of the art, and that's because of the huge amount of computational work that is done in both in agriculture and veterinary science. So because of that, they set up this big computer center, and then also a computer science department. So in that sense, I had the opportunity to work on what at that time was one of the leading computing platforms, the IBM 360. And I had some really good faculty, and that really got me going with software development. I particularly liked assembly level programming, which is at the machine instruction level on the IBM 360. And the IBM 360 architecture, you probably were not born at that time. So it was a very unique architecture at that time. I mean, just like what people are talking about NVIDIA chip today. And in those days, the 360 transformed enterprise computing and software. So it was a great experience at Kansas State, and good faculty, good students, learned a lot. And also I did my master's was in using building a software system for text generation for question and answers, creating a knowledge base. So overall, very, very productive, couple of years at Kansas State.
Whenever we are starting on a journey, starting a venture, there is this defining moment that tells us, okay, this is a problem we want to solve, and this is what we're passionate about. So even with Self-Best, there was a moment where I personally felt that I'm not realizing the full potential of who I can be. And as you shared, you had a lot of customers in banks, and you got exposed to financial services as a whole. But was there a specific moment, a defining moment, that drove you closer towards what you're doing with StockSnips today?
So my previous company, enterprise software company, I actually was able to grow the company and take it public on NASDAQ. So we actually listed on NASDAQ. When I did that, that's when I got exposed to the public markets. And one of the things I found was that the SEC regulations, where every public company has to file a quarterly and an annual report, and those tend to be fairly long reports. There are hundreds of pages, and with a lot of and even at that time, I realized that for an investor to read a 10Q or a 10K, it does take a lot of time. And given my background in exposure to natural language processing and all of the developments that had taken place, so when I started StockSnips, my initial problem I wanted to solve was, can machines read these large articles, and can they make a summarized, extract the relevant parts of that article and create a summary intelligently, right? So that was my initial thoughts. And I hired a few Carnegie Mellon students. Yeah, I built a prototype, and things were successful. And building a prototype where we could read this large article and break it down into what we call snippets. That's where the name StockSnips comes. And those snippets could then be summarized by topic. You could arrange them by topic. So now, to an investor, those 100 pages are now reduced to these snippets and organized by topic, as well as whether what is being said is positive or negative, which means you're also doing some classification of whether what that particular snippet is, it positive or negative. So that's kind of was the problem I set out to solve, even though we've pivoted a couple of times after that. But that was the beginning.
A lot of our audience also does investing, and specifically, investing in the stock market. The very basis of StockSnips is, the high correlation between the sentiments that are there in the news articles to the stock prices, right? So if you could just tell us a little bit about that, maybe give some insights to the audience on that aspect.
So once we solve this problem of machines being trained to read financial text, financial, and be able to pick out, extract relevant information, the next thing was, when we started doing classification, positive and negative, that's when the idea came up saying, can we actually create a score, a sentiment score? I mean, sentiment analysis was not new. So except that, the content that we were processing was somewhat different. And the second thing was that when I studied the stock market, I found that over the last 10 years, stock prices were not only driven by what is called fundamentals, which is revenue, earnings, growth, momentum, and so on, but they were also being driven by people's beliefs and emotions, right? And then when I looked around, there wasn't a data set or a score, and that's when I saw the opportunity. That was the opportunity, saying, can we create a continuous measurement of investor sentiment and then validate that as that to have predictive value? It took a few years because you had to curate the right content. For example, we read about 40,000 articles a day, and then attribute that to the 5,000 US equities. And that's a tough problem. That in itself, just the attribution to get accuracy, you think machines are smart, but they're not. If you give a machine an article and say, tell me what are the companies mentioned in that article, I mean, you get a lot of errors, what is called named entity recognition, right? It's gotten better, but still you need to train them. So that's kind of what, so from reading articles, summarizing them, classifying them, now we said, if you can create a 360-degree view, that means get articles from different sources, diverse sources, and create a continuous measure of investor sentiment. And then, of course, there are other steps to prove validity and so on.
So, a little bit of follow up on the previous answer. So, like, in terms of the sentiment signals, how do they drive investment strategies? If you could tell a little bit about that.
So, as I was mentioning, so first is we created a score for every US equity. There are 5,000 of these. Not all of them get the same amount of news. The other thing we found was news is discrete, it's not continuous, because you get a bunch of articles for a particular company and then there would be no news. So that in itself created a problem, because the arrival of news it's not a normal distribution, it's more of a Poisson distribution. So what we had to do then was say, in terms of after extracting the relevant parts, classifying, generating a score, then we found that what happens to sentiment if there's no news? Because does sentiment go to zero? The answer is no. People have memory, right? You read an article, you remember. So we had to create a model, what is called a memory sentiment decay model. How long does someone remember an article once they read, right? And the rate at which that sentiment decays, we found to be related to the volume and arrival of new news. So, for example, you read something 30 days ago, and you remember it for and then you start forgetting what exactly was said 30 days ago. But the rate at which it decays, there's a lot of new news. It's likely that you'll forget what was said 30 days ago. So that was another unique aspect of our sentiment signal generation. Not only the content curation and the attribution and the classification, but also building a memory sentiment decay model. Once we do that, then you still have to prove. How do you know that this signal is more noise than, the signal to noise, as they say? So the way to validate that was to do various statistical studies, lead-like studies, where you say, if, is sentiment correlated with change in price? We also did a regression study, actually, a PhD student from Carnegie Mellon, along with a professor of finance. They took our data and we gave our data to them. So they simulated a trading strategy on a daily market neutral trading strategy. And the returns were then regressed against the conventional French five-factor model, which are the fundamental factors. And then they measured what is the alpha or what is the excess return that can be attributed to sentiment. And those studies proved that was one validity, in addition to our internal statistical, correlations and so on. The CMU regression study was also a good way to validate the signal. We also gave our sentiment data to a Wall Street equity research firm. It's a well-known boutique research firm called Cirrus Research. They have 30 years of fundamentals data. What they did was they looked at our sentiment signal and again simulated a trading strategy and compared it with other predictive indicators they were using. They were what is called relative strength, which is a price momentum, and the other one is a earnings revision estimates. These are actually two popular predictive indicators that are used to predict the stock, change in stock price. And they found that our signal was quite robust. It was actually correlated with RSI, but was better, more consistent. It was not correlated with earnings revision, but it was still, the signal was strong in terms of its predictive value. So these internal studies by academic researchers and Wall Street equity research firms confirmed that sentiment was a lead indicator of price change. Of course, not all the time. That means you won the jackpot if you can predict. But the signal was sufficiently strong that 65% of the time, this particular pattern where sentiment goes up, price goes up, sentiment goes down, price goes down. That's the validity that we were able to prove through these studies.
So, specifically when it comes to investing in finance, trust becomes really important. So, people can trust a human advisor. It's easier for them. Usually there's familiarity. They trust the person as an individual. However, with StockSnips, it's kind of trusting an algorithm. So, how do you sort of deal with that? And what is your sort of perception when it comes to trusting technology for investing?
That's a good question. But if you look at the evolution of the stock market, so use of quantitative methods is not new. You go back 30, 40 years, they were using mathematical models, statistical models. So the use of models to predict or discern patterns and then come up with an investment strategy, that's not new. So AI is nothing but an extension of these quantitative models. Obviously, some of these models are much more black box and more complex, so more difficult to explain. What I tell people, first of all, we're not disintermediating the human wealth advisor. That role will always remain. That relationship with the client, that is, and understanding clients' requirements, their needs, their retirement goals, financial planning, estate planning. So that remains. But when it comes to picking stocks or building an active portfolio strategy, that's where machines can help, and they've been doing this over the last 30 years. Now AI is actually even a better way to do it. The reason for that is, if you look at the stock market time series data, it is non-stationary and non-linear. So normally, if the assumption is that there's a linear relationship between returns and some of the other factors, for example, earnings and say price change, but it is not. You really can't. It's not a straight line like this, right? You'd get a non-linear pattern, and AI is better at that. Traditional quantitative models are not good at dealing with non-linearity, whereas AI models are. That's really why AI is now beginning to be more relevant to analyze, stock market time series data.
There's an increasing investment in AI in finance. It was to be 58 billion in 2025 and almost doubling in 2028 to 126 billion. So what is your perspective on where this is going? Like, what do you think is the goal that everybody is trying to achieve with investing so much in AI in finance? Is it higher returns or replacing someone? What is the ultimate goal here?
Well, both AI and finance are very broad terms, right? AI encompasses many. There's natural language processing, there's machine learning, there's reinforcement learning, and so on. Finance, again, you've got capital markets, asset management, you've got wealth management, you've got personalization, or even things like communications, investor communications with clients, or even your traditional CRM, where if you're an advisor, who is your ideal profile? So it's very broad. So the applications of AI can be in the use cases or across many aspects of financial services. So to begin with, one of the biggest problems for the advisor is, who should he target and how much time should he spend, right, with that particular client. Traditional methods, you would end up chasing, various leads and spending a lot of time and not very productive. Now what happens is, if you looked at the data available from LinkedIn or other social media sources, this is where, again, AI can help. So AI can do that grunt work of creating that funnel, saying, here are all the people that fit your profile. You're looking for a certain target. So it can, if there are 100,000 people out there, it can reduce and say, here are the 10,000 that are likely to be a better fit for you. Now, within that, you can further, use more advanced algorithms to fine tune your lead generation program. So now what the advisor, instead of chasing and spending time with leads that are not a good fit for him, he can be much more productive. So it's not replacing him; it's actually increasing his productivity. That means he can service, his productivity and the amount of money he can manage, the number of clients he can manage, dramatically increases. So I see it as a positive. Now, when it comes to those type of things, and the communications is another very laborious task that the advisor has to do, because he has to communicate with, if he has 100 clients, he has to personalize his communications. And if he's so this is where, again, AI is coming, especially Gen AI, which we saw in the last couple of years, with the rise of ChatGPT and so on, large language models. That is coming to the aid of this personalized communications. The other aspect, which is asset management or portfolio construction, that's a more advanced use case. That's much more harder to do. There's a lot of progress being made there, and including what we're doing at StockSnips. We are beginning to look at how you can select stocks and in an optimal way and optimize returns. And there the goal, of course, is for a given risk, optimize return. So it's risk-adjusted returns. You can get a return, but the risk could be very high, right? So most often, different advisors will want investment strategies for different risk profiles.
There's also a trend of Robo Advisors. So what is your perspective on them, and what do you see in the future, when it comes to them?
Robo Advisors actually haven't done very well.
Okay.
So that happened about, I would say, 10, 15 years ago.
Mm-hmm.
And people poured a lot of money into it. If you look at companies like Wealthfront or Personal Capital or Betterment, huge amount of money was spent. And for a while, people thought this is going to disrupt, these robo-advisors are going to disrupt the traditional human advisor. But then what happened is, people like Fidelity and Schwab and Vanguard and others, who had a large number of advisors and clients, they actually adopted this same tools that the robo-advisors were using, which is basically nothing but looking at a user profile and suggesting appropriate investment strategies. What they did was they added the human element into it, which is actually better.
Yes.
Because you're not disintermediating the advisor, but so instead of a complete automated robo-advisor, what Schwab and Fidelity and others did was to incorporate that into their advisory services. With that, what happened, if you see now, the robo-advisors really haven't grown as much as they were supposed to grow. They're still there, and they have, and especially, so what has happened is they're good for very entry-level type of investors, very basic investing. As soon as you move to the next level of a little more sophisticated advisory services, that's where, all these more, whether it's Morgan Stanley or BlackRock or Fidelity or Schwab, they have incorporated that into their, and basically, so human plus AI is really what is, I would say, is at the moment, that's what has succeeded better than just say a pure robo advisor.
When I talk about investing, as an investor, whether it's you or your advisor who is human, we have certain biases, right? So when there is a machine sort of taking that decision or doing some sort of an analysis, how is the bias different? Uh, is it something that they don't have? Is it a positive aspect when it comes to machines when they're doing the similar kind of analysis? If you can just tell us about a little bit about bias.
There's various kinds of biases. There's bias in the training data, for example.
Yes.
If the data you're using to train the classification model, the machine learning classification model, then it's going to behave in a certain way. There is also the type of, now when it comes to making choices, investment choices, conventionally portfolio managers, being humans, they cannot eliminate their own beliefs and emotions.
Yes.
It's not 100% data driven.
Yes.
They're overriding the data and putting their own human judgment, and that could work sometimes, and it could also create problems, right? So that's where quantitative methods and now AI are have come in to provide more of a non-biased, selection of stocks in a given portfolio, because there is no human. These machines don't have any particular emotion. They're simply looking at the data and making a decision. Now, is that perfect? The answer is no, because again, this is where human oversight, especially when it comes to risk, right? So the machines can identify the risk, but the final decisions are again taken by a portfolio manager or a human portfolio manager. So again, I think where we are today, it's a combination of using AI as a tool to extend your cognitive capabilities. But when it comes to the intuition and actual decision making, I think the human is still involved.
So, financial services have evolved beyond traditional banking, with more than 76% of CEOs in financial services wanting to acquire more and more companies in the next 3 years. The competition is fierce. If they don't innovate, they will fall behind. So, what do you think innovation will look like for these companies when it comes to fintech, and how do you think they can adopt to stay ahead of the curve?
So, first of all, just at the macro level, and now I'm talking about the US, not the world market, but I have a feeling it's very similar. There is a huge amount of what is called a generational wealth transfer that's happening. So, of the $140 trillion, something like $70 trillion of wealth is going to move from the baby boomers to what is called the Gen X and the millennials, right? So that is, and so the demographic of the investor is dramatically changing. A baby boomer is 60 and above, right? And the advisors who are servicing them, they're also in their late 50s or 60s. Now suddenly you've got this demographic change in the investors, and we're also seeing a change in the demographics of the advisors themselves. If you look at our average client now, they're in their 40s. So now you have both the investors and the advisors who are much more tech savvy. The traditional financial advisor, you would meet a client, in a coffee shop or or in their office, much more relaxed, and the way they interacted and collected information was more traditional. Now, if you look at the Gen X and millennials, they are digital. They were born in the digital era, and the rate at which information they can consume and then make decisions are much faster. So that's what this industry has to cope with, and this is where technology is coming to their aid, right? So suppose you're first of all, a lot of the communication may not happen in person. It could be online it could be through Zoom or even through a chat, right? So now you need these tools. So the advisor needs a whole set of new tools on client engagement, communications, and building that relationship presence. Most of the older advisors, they may have a website, but they don't have much of a social media presence, right? Or even if they do, they don't know how to use that medium effectively. So you can see the entire spectrum from acquisition of a client, interacting with the client, communicating with the client. And then when it comes to investment strategies, these tech savvy new investors, they're not satisfied if an advisor simply, puts your money into what is called passive strategy. Passive means that you're investing in a broad index or the entire market, right? So, for example, in India, that would be the Nifty 50, and so on. In the US, it's the S&P 500, which represents the 500 largest US companies. So these passive strategies over the last 10, 15 years have outperformed what portfolio managers were doing, right? Active portfolio managers. Now, and these are available easily for purchase by, if you're tech savvy, you can go online and you can buy a passive index strategy. So you don't need an advisor anymore for simply for that task. So the role of the advisor is dramatically changing. He has to truly be an advisor. He can't just, build, he can't assume that his clientele are not knowledgeable about, how to purchase an ETF that is a passive ETF. For that, they don't need an advisor. They're not going to pay a fee, right? So that's what's happening. So now, which means that you need to come up with investment strategies that suit the appetite of these new set of demographics of investors. These could be thematic. There could be the millennials. They want to invest in companies that are environment friendly.
Right.
They may be interested in companies that are more technology, AI. A thematic fund which has more of the AI or technology companies in the portfolio. So now so the type of strategies you have to create, and much more personalized, and would have to be a much more diverse set of strategies as opposed to conventional, what is called 60-40, 60% equities and 40% in bonds or other type of fixed income assets. That is not going to work, where you just sit with the client and do a 60-40 and then don't do anything for the next few years. That is not going to work. So that's where we're seeing a much more dynamic, starting with client acquisition, communications, and portfolio management. Across all of that, you're going to see a dramatic change in use of technology and innovation to be able to stay competitive.
So, building on that, I mean, AI-driven solutions require transforming huge amounts of data. So, what do you think are the regulatory and as well as ethical considerations when it comes to dealing with that scale of data?
That is called governance and compliance, right? There is something called the Securities Exchange Commission in the United States, just like SEBI here in India. So they are grappling with that. They are saying, okay, how do we protect? Their role is to protect the investor.
Yes.
So, and that has always been a problem, right? Whether it's a financial advice that is based on without using any quantitative models, what is called discretionary portfolio management, or even use of quantitative models. The SEC has compliance and guidelines, because you cannot mislead an investor, because you're dealing with their life savings, and you cannot misinform them or suggest strategies that are not the right kind of risk for that type of profile, right? Let's say he's a retiree and he's looking to preserve his savings. You cannot go suggest a very aggressive high risk strategy, right? So, and the other thing is the asset classes have now become more complicated. You've got what is called alternative investments, things like cryptos, things like NFTs.
Yes.
So there's many more asset classes that have come up other than just stocks and bonds, and there is a interest in the investors are interested in these alternative assets, especially when it comes to private equity, venture funds. So even a smaller investor now can participate in a venture fund or in a private equity, which was otherwise available only to some very large asset management firms or hedge funds and so on and so forth. So that is, I would say, puts makes the job of the SEC more difficult. But I believe we are seeing a lot of new guidelines come out. For example, in our case, because our models are AI-driven models, we've had to come up with ultimately, compliance is nothing but disclosures of the risks involved in when you choose a particular strategy. So in this case, you have to be very clear. If the investor wants to invest in, say, an AI-powered model, they need to know what the risks are. Return is one thing, but what are the risks?
Right.
What are the things that could go wrong? So the disclosures have changed. So at the moment, the way the investor is protected is what are the things you should look for, in an AI-driven strategy, so that the investor's risk is minimal. You cannot eliminate risk, but at least he's aware of what he's doing, right? What happens if I buy a highly volatile stock versus if I buy something that is a steady, what is called a low volatility stock? The return may be lower, but it's not going to go, oscillate between high returns and low returns, right? You're not going to lose your capital. So I think it's more about explainability of models and the corresponding disclosures to the investor. That's where it is today. There could be more other types of protections that may come out, but at the moment, I have not seen anything of that kind so far.
We talked about Robo Advisors. It was a trend that didn't really, make an impact that it was out to make. So in the current scenario, what do you think are some of the trends that you think will stay and some of the trends you think wouldn't stay, specifically when it comes to the financial sector?
The broad trend we are seeing is, if you look at the way portfolio managers and asset managers were dealing with investment strategies for clients, there were different kinds of mutual funds. There were a large number of mutual funds. So if you're an investor and you want a dividend-based strategy, you pick a mutual fund that has, exposure to, dividend-generating companies. Conventional mutual funds are less flexible from an investment perspective. So there is a move towards what is called an exchange-traded fund, what is called an ETF. And the ETF is nothing but a mutual fund, but it trades on the stock exchange, like NASDAQ or New York Stock Exchange. So it's much more liquid, much more easier to acquire and redeem. So if let's say you want an exposure to a growth equity strategy, you can, instead of a mutual fund for growth equities, you'll buy a ETF, and you can get in and get out. There are no minimums. You can buy $100 worth of an ETF for $100,000. Mutual funds had rules. You had to have a minimum amount. There was a certain amount of time. You can't just go and buy any time. There was a waiting period. There were also all kinds of expenses, sales expenses and management fees. So ETFs are very efficient that way. The fee is all included. There is no selling fee. So the growth of active ETFs is huge. In the next 3 years, the active ETF market is likely to be $14 trillion. And a lot of the mutual funds are moving towards ETFs. And more importantly, because earlier I mentioned to you, almost 50% of the assets have moved into passive indexed funds of various kinds, whether it's the NASDAQ or S&P 500 or the Russell 2000. Now what's happening is advisors and asset managers, in order to stay competitive with these passive systematic funds, they're having to adopt more of a data-driven systematic strategy. So you'll see so the other trend I see is that portfolio construction management is going to be much more systematic, data-driven, and this is where, again, AI comes in. As soon as you're talking about, systematic and data-driven, as I mentioned earlier, AI is better at recognizing nonlinear and non-stationary patterns. So that's what I've been quoted in many sources saying that the future is in systematic data and AI-driven strategies delivered in the form of ETFs, of active ETFs. which means it brings the efficiency and cost down. And at the same time, you're dealing with more adaptive strategies. That means buying and holding for 10 years is not there'll still be, you would just go to a passive fund. You don't need an active fund if you just want to buy and hold for 10 years, right?
Right.
You might as well just buy a index fund, and they're very cheap. Vanguard and State Street and others have made it very affordable. So in a nutshell, that's what's happening. So there is going to be a shift in the type of products, and that'll require use of systematic approaches that are data and AI driven.
So launching a successful fintech startup requires more than just an idea. It's more about the execution, the resilience, and to just stay ahead of the curve. And you've had so much experience just being an entrepreneur as well as working in technology solutions. So what would be your piece of advice to founders who are looking to launch fintech solutions in the industry? What are different challenges you sort of faced during your journey, if you could share that, and if you have any tips and advice for them?
The thing I tell anybody that comes to me and says they have an idea and they want to start a new company or start a venture, the first thing I tell them is, are you prepared to run a marathon? This is not a sprint. Building a company is not a sprint. You hear of success stories, but if you take NVIDIA, I mean, it's the rage today, but it took 20 years, right? And I don't think Jensen Huang knew that he was going to end up where he ended up. So that's the first advice, is that from idea to translating from an idea to a technical solution, and then the economic viability of that, all of that takes time. And the other thing is you have to keep pivoting until you have a minimum viable product. And for me, a minimum viable product is not just a good technical solution, but something that really creates compelling value for the user. Whether the user, in our case, it's the investor, or in the case of some other industry, it could be an industrial client or a retail client. So you have to create compelling value before you can scale. And a lot of people are in a rush. I keep hearing stories of somebody raised $20 million or $50 million. They have a great idea, they have a great team, they probably even have great technology, but they raise more money than they need before they reach what is called the inflection point, which only comes when you create compelling value. This idea that you raise a lot of money and somehow value will get created, and that's why you see very high mortality in venture funded companies. Only probably less than 5% succeed ultimately, right? So that's the danger of raising great idea, great technology, but you haven't yet proven what is the value for the actual client. So that would be my single biggest advice to any. Doesn't matter AI or non-AI, it doesn't matter. So the question you have to keep on saying is, so what? Suppose someone comes, oh, I've got this super special AI algorithm and it does this and does that. That's just the how, right? But why? Why should the why aspect is the most important. Why should a user care? What will it do for the user? How will it impact whether it's their user experience or whether it's in our case, if it's an investment strategy, what does it do to them in terms of risk-adjusted returns? So that's ultimately, what if you're doing fintech, and there's a wide variety in fintech, it doesn't matter what it is, compelling value, not technology, not just buzzwords. And I mean, look at Gen AI. There's 1,000 Gen AI companies all over the world now. Are all of them going to succeed? No. The ones who will succeed are the ones who are able to pick the right use case and create that compelling value, and then the rest of them will go by the wayside.
So if you weren't in AI and finance, what field do you think you will be in?
My passion has been history, and music. So
okay. Definitely, I know about music for sure.
So I could spend all my time, learning an instrument or or singing and so on and so forth. I also like teaching history and all history of all kinds. Uh, I'm also very passionate about anthropology, social behavior, how do human beings interact. And that has a anthropological basis to it, and how from the outside how we interact is actually driven by all of these other factors that are very basic to human evolution, right? So I would probably have ended up so maybe in a university somewhere doing research and teaching and so on and so forth.
And if you would want AI to take one part of your daily life and just take it over, what aspect would that be?
There's a lot of chores that you do, especially around the house, right? So I think the thing that I find most painful, and if someone here's an idea for an entrepreneur, taking weeds out of grass, from your lawn. If you can do that, accurately, I would love that because that's where I get very, very tired when my wife asks me to go weed the lawn, take out the weeds. I wish there was this super robot that I could turn on my lawn, right? And that would be actually I've seen robots in our neighborhood. We have robots that cut the grass.
Yes.
But they can't take out the weeds.
So we need the machines to get more intelligent.
Yes, that's a tough problem, actually.
Yeah. If you could travel back 20 years, which tech trend would you want your younger self to invest in?
Like I said, right, my passion was in programming and building software and so on, reliable software, and software for large enterprises, right? But the one thing that I found was very important, which I wish I had more background in, is data analytics. Data analytics, statistical modeling. I wish I had more exposure to that, because here we are 20 years later. I don't think there's any aspect of technology which does not use some kind of data mining, data analytics, and statistical modeling. So I do find a little bit, handicap. I've learned on the job kind of thing. And fortunately, my co-founder is a brilliant data scientist. I've learned a lot from him. But I very often, when I read a interesting paper or an interesting solution, if you look under the covers, there is some very interesting data analytics and algorithms,
Yes.
and which make that difference, right? So I wish I had that background.
So according to you, what's that one thing that you think AI cannot do better than humans?
In spite of all of the developments in AI and the talk of the super machines, what is called artificial general intelligence and so on, I think when it comes to human intuition, human emotions, feelings, caring for someone, I don't think, that you could create a robot that you can sit and talk to, but I don't think it's the same thing as interacting with another human being or an animal, right? It doesn't have to be another human, but that emotion, whether it's a dog or a cat or a chimpanzee or whatever your favorite pet is, I don't think humanoids or robots can or computers can replace that. I hear people who say they sit in front of a computer and that gives them some level of satisfaction, but I think it's not the same as human interaction.
So I would like your recommendations for the audience now. Which is one book or podcast that really influenced how you looked at AI and investing?
There are many interesting ones, but I would say that the thing that I learned a lot from, it's called The Epistemology of Deep Learning by Jan LeCun. It was a lecture at the Institute of Advanced Studies at Princeton. He gave that lecture because someone from, I think it was a scientist from Google, who kind of said that deep learning or neural networks are an alchemy. It's not science. So Jan LeCun, who had built some of the when it came to image recognition models, that was built by Jan LeCun. One of them was built by Jan LeCun. So that's a very interesting lecture. That, it's not a podcast; it's a lecture. I would say people should listen to that if you're interested in AI, because he starts with the beginning of the early neural networks, all the way from a perceptron and how a neuron works, and all the way to where we are today. And in a very systematic way, he tries to counter this thing that this is not alchemy. This is actually could be. There is obviously some elements of it that looks like black magic because it's a black box, but I think more and more people are realizing that these models can be, you can interpretability, explainability. These are all areas that it works. But why does it work the way it works? I think it's more of research. So it's not that it's alchemy. It's just that you still haven't done some of the work that's needed, the type of research needed to make interpretability and explainability, which I think will be there. You'll see that in the next few years.
Would you have any other recommendations of resources that new entrepreneurs can look at?
Again, there's a wide variety, but one of the most successful investment strategies or hedge funds was Gene Simmons, and the book is called "The Man Who Solved the Market." That's a very interesting read because he used AI 20 years ago, and much before we were seeing the current powerful models that have come out, and very successfully built various investment strategies, and has delivered huge returns. And that has not yet been replicated, or other people haven't done that. I hope we can do that here at StockSnips, but yeah, but that's kind of a very inspiring book. If I roll back like 30 years ago, I would say the book that really inspired me it's called The Soul of a New Machine. That's the story of Data General's mini computer. It's a beautiful book. So there's one can go on like that. There's many books, but I would say those are a few of the ones that I would recommend.
If there are certain tools and softwares that you use in your daily life, if you could talk about them, which is the best tool that you've used?
Again, I think the context in all of these things, context matters. When it comes to interacting within our company for technical matters, I find Slack to be a very, very convenient, and is really keeps you on top of communicating with your other developers and employees. In the area of marketing and communications, I found Canva. Canva is another tool that is really changed. We used to use PowerPoint all the time, and
Yes.
And especially with multimedia presentations, I think Canva is a great tool. There are some very other very interesting tools. There is a tool called Wondershare, Wondershare Filmora. Folks like, I don't know if you use that or not, but that's for video editing and audio editing and so on. And we use that for creating our videos and podcasts and so on and so forth. There is other technical platforms, like for example, analytical platforms. We use a couple of them. One is called ETF Action. That has data on all of the ETFs in the United States, and you can get lots of interesting insights into fund flows and performance, and the type of risk exposures. So it's a very useful platform that we use almost every day, because we track our ETF, and we can compare our ETF with 100 other ETFs.
Right.
So when we are presenting to a client, it's very easy for us to, we can look at the risk, we can look at the returns, we can look at the holdings, we can look at, what's the constitution of those holdings. Is it sector distribution, style distribution, size distribution? So it's basically slicing and dicing of data. So it's data analytics on steroids for ETFs. So,
how would you define your leadership style?
my leadership style has always been, I'm not a taskmaster. I I try to hire good people and then just give them a lot of freedom and flexibility. Good and bad in the sense that sometimes you're letting people, giving people too much freedom, but that's, I would say, my style is more of encouraging and cooperating with people that I hire, uh, and so it's not a hierarchical authoritarian type of style. It's more of a, let's hire a good team and have some fun, building something exciting. So it's more encouraging. So even if someone's not doing very well, you try to help them and get them to do better. Is kind of, so more of a coach kind of a style, a coach and inspiring them to do better.
So we have come to a closure for this podcast, and today we learned a lot about fintech investment strategies and how AI is influencing this specific domain. So watch out for our next podcast and keep making those interesting investment decisions, and let's see how many returns you're getting the next time we meet. So see you then.